Hey, you awesome people. Go ahead, smash that like button like there's no tomorrow. Got buddies who'd love this? Share it, they'll thank you later. And oh, don't be a stranger, hit subscribe and ring that bell, so you don't miss out on our epic new content. Thanks for being part of our wild ride. Today, we're going to demystify a topic that's often seen as complex and intimidating: investing. This is your one-stop resource, a comprehensive guide to investing for beginners. Whether you're just starting your career, midway through, or thinking about retirement, this video will equip you with the knowledge you need to navigate the world of investing. 1. Understanding the basics of investing. Investing is the process where you allocate your money with the expectation of receiving more money in return in the future. But why should you invest? Well, simply storing your money in a bank account won't help your wealth grow significantly. Investing, though it involves risks, offers the potential to grow your money at a rate that outpaces inflation. You're essentially making your money work for you 24/7. However, remember the golden rule of investing: higher potential returns usually involve higher risks. That's why it's crucial to understand your risk tolerance. Why people invest? People invest for various reasons, such as growing their wealth, preserving their purchasing power, generating passive income, and saving for specific financial goals like retirement, education, or a down payment on a house. Investing is an essential part of financial planning, as it helps your money grow over time and protects it against the eroding effects of inflation. The power of compounding. One of the key concepts in investing is the power of compounding. Compounding refers to the process of earning returns on both your initial investment and the returns that have already been generated. Over time, compounding can significantly grow your wealth. The earlier you start investing, the more time your money has to grow, and the more you can benefit from the power of compounding. Risk and return. Investing involves a trade-off between risk and return. Generally, investments with higher potential returns come with higher risks. It's important to understand your risk tolerance, which is influenced by factors like your financial goals, investment horizon, and personal comfort with potential losses. A well-thought-out investment strategy will balance risk and return to align with your individual needs and goals. Types of risk. There are different types of risks associated with investing. Market risk is the risk that the overall market will decline, impacting the value of your investments. Credit risk is the risk that the issuer of a bond or other fixed income investment will default on their payments. Inflation risk is the possibility that the returns on your investments won't keep pace with inflation, reducing your purchasing power. Other risks include liquidity risk, currency risk, and interest rate risk. Understanding and managing these risks is a crucial part of successful investing. Building a diversified portfolio. To mitigate risks and build a more resilient investment portfolio, it's essential to diversify your investments. This means spreading your money across different asset classes, industries, and geographic locations. A diversified portfolio can help protect you from the poor performance of any single investment, as losses in one area can be offset by gains in another. Diversification is a fundamental principle of investing and plays a critical role in managing risk and optimizing returns. 2 different types of investments. Let's delve into the different types of investments. First, we have stocks. When you buy a stock, you become a part owner of that company. The value of your stocks can rise or fall depending on the company's performance. Bonds, on the other hand, are like IOUs. When you buy a bond, you're lending your money to the issuer in exchange for regular interest payments and the return of the principal amount when the bond matures. Mutual funds offer a way to invest in a diversified portfolio, managed by professionals. Real estate investments can range from owning rental properties to investing in real estate investment trusts, REITs, which trade like stocks. And lastly, we have cryptocurrencies, digital or virtual currencies that use cryptography for security. Stocks. Stocks, also known as shares or equities, represent ownership in a company. When you buy a company's stock, you become a part owner or shareholder of that company. Stocks are traded on exchanges and their prices fluctuate based on supply and demand. The performance of a company, the economic environment, and investor sentiment can all affect stock prices. Stocks offer high return potential but also come with higher risk compared to other investment types. Additionally, some companies pay dividends to their shareholders, providing an additional income stream. Bonds. Bonds are debt securities issued by governments, municipalities, and corporations to raise capital. When you buy a bond, you're essentially lending your money to the issuer in exchange for regular interest payments and the return of the principal amount at the bond's maturity date. Bonds are typically considered less risky than stocks, but their return potential is also lower. The riskiness of a bond depends on the creditworthiness of the issuer, with government bonds generally being the safest. Mutual funds. Mutual funds are investment vehicles that pool together money from many investors to invest in a diversified portfolio of stocks, bonds, and other assets. This allows individual investors to gain diversification and professional management with a relatively small amount of money. Each investor in the fund owns shares, which represent a portion of the holdings of the fund. The performance of a mutual fund depends on the performance of the assets it holds and the skill of the fund manager. Real estate. Real estate investing involves buying properties for rental income or capital appreciation. Rental properties can provide a steady income stream, while the value of properties can increase over time. However, real estate investing requires significant capital and management effort. Real estate investment trusts, REITs, offer a way for individual investors to invest in real estate without the need to buy and manage properties themselves. REITs are companies that own and often operate income-producing real estate, and they are required to distribute most of their income as dividends to their shareholders. Cryptocurrencies. Cryptocurrencies are digital or virtual currencies that use cryptography for security. The most well-known cryptocurrency is Bitcoin, but there are thousands of others, including Ethereum, Ripple, and Litecoin. Cryptocurrencies are typically decentralized and operate on a technology called blockchain. They can be used for a variety of digital transactions. Cryptocurrencies are highly volatile and speculative, offering high return potential but also high risk. 4. How to start investing. To start your investment journey, you must first set your financial goals. Are you saving for a new house? Funding your child's college education? Once you have clear goals, you can choose an investment platform that aligns with these goals. Set clear financial goals. Before you start investing, it's crucial to set clear, specific financial goals. These could range from buying a house, funding a child's education, starting a business, or retiring comfortably. Your goals will shape your investment strategy, including the types of assets you invest in, your risk tolerance, and your investment horizon. Establish a budget. Establishing a budget is an essential step in the investing process. Determine how much money you can comfortably set aside for investing after accounting for your necessary expenses. Remember, it's important to maintain an emergency fund for unexpected expenses before you start investing. Choose an investment platform. Choosing the right investment platform is a key step in your investing journey. There are various platforms available, including online brokers, robo-advisors, and traditional investment advisors. Each comes with its own set of features, fees, and minimum investment requirements. For beginners, robo-advisors can be an excellent choice because they provide automated, algorithm-driven financial planning services with minimal human supervision. Understand different investment accounts. There are different types of investment accounts, and the right one for you depends on your goals. A taxable brokerage account is a standard account where you can buy and sell a wide range of investments. Retirement accounts, like 401ks and IRAs, offer tax advantages for retirement savings but have rules and restrictions about when you can withdraw your money. Education savings accounts, like 529 plans, offer tax advantages for education savings. Start investing. Once you've set your goals, established a budget, choose a platform, and set up your account, it's time to start investing. For beginners, it can be wise to start with a diversified portfolio of low-cost index funds or ETFs. As you gain more experience and knowledge, you can start to explore other investment types. 5 investment strategies for beginners. Once you've set up your investment account, it's time to devise a strategy. Diversification, or spreading your investments across different types of assets, can help you manage risk. Another strategy is dollar cost averaging, where you invest a fixed amount regularly, regardless of the price of the investment. This strategy can help mitigate the risk of market volatility. And remember, successful investing typically involves a long-term commitment. It's not about timing the market, but the time in the market that counts. Diversification is the strategy of spreading your investments across different asset classes, sectors, and geographical locations. By not putting all your eggs in one basket, you reduce the risk of a single investment or type of investment significantly hurting your overall portfolio. In other words, losses in one area can be offset by gains in another. Diversification is not about maximizing returns. Instead, it's about achieving a balance between risk and return. Dollar cost averaging. Dollar cost averaging, DCA, is a strategy where you invest a fixed amount of money at regular intervals, regardless of the price of the investment. This could be monthly, quarterly, or on any other consistent schedule. This strategy can help you avoid making large investments at inopportune times and can reduce the impact of market volatility. Over time, DCA results in purchasing more shares when prices are low and fewer shares when prices are high, which can potentially lower the total average cost per share of the investment. Asset allocation is the practice of dividing your investment portfolio among different asset categories, such as stocks, bonds, and cash. The purpose of asset allocation is to reduce risk by diversifying your investments. Your asset allocation should reflect your investment goals, risk tolerance, and investment horizon. For example, a younger investor with a long time horizon and higher risk tolerance might have a higher allocation to stocks, while an older investor nearing retirement might have a higher allocation to bonds and cash. Rebalancing. Over time, your actual asset allocation can drift from your target allocation as some investments perform better than others. Rebalancing is the process of realigning the weights of your portfolio's assets. This often involves selling high-performing investments and using the proceeds to buy more of the underperforming investments. Rebalancing can help you maintain your desired level of risk and return. Long-term approach. Finally, a successful investment strategy often involves a long-term commitment. Short-term market fluctuations can be unpredictable, and trying to time the market is usually a losing game. Instead, focus on building a diversified portfolio that aligns with your long-term goals and risk tolerance. Remember, it's not timing the market, but time in the market that counts. Each of these strategies plays a key role in managing investment risk and potentially enhancing returns. By understanding and implementing these strategies, you can make more informed investment decisions and increase your chances of achieving your financial goals. 6 common mistakes to avoid. Even experienced investors can slip up. Some common mistakes include investing money you can't afford to lose, chasing hot stocks based on rumors or tips, and making impulsive decisions driven by fear or greed. I've had my share of investment blunders, and I'll share these experiences so you can avoid these pitfalls. Investing money you can't afford to lose. It's crucial only to invest money that you can afford to lose. This doesn't mean that you should expect to lose money when you invest, but investing always involves some level of risk. Ensure you have a solid emergency fund in place and that you're not relying on your investments to cover basic living expenses. If you invest money you need in the short term, you could be forced to sell your investments at a loss if the market goes down. Chasing hot stocks based on rumors or tips. Many beginners make the mistake of investing in hot stocks based on tips from friends, family, or the internet. While it can be tempting to jump on the bandwagon, investing based on rumors or tips is usually not a good strategy. It's important to do your own research and understand what you're investing in. Instead of trying to find the next big thing, focus on building a diversified portfolio of investments that align with your financial goals and risk tolerance. Making impulsive decisions driven by fear or greed. Emotions can be an investor's worst enemy. Fear and greed often lead to impulsive decisions, like selling out of fear when the market drops or buying out of greed when the market is soaring. These behaviors can result in buying high and selling low, the opposite of a successful investment strategy. It's important to stay calm and stick to your long-term investment plan, regardless of short-term market fluctuations. Neglecting to diversify. Putting all your eggs in one basket can be a risky strategy. If that one investment performs poorly, your whole portfolio could suffer. Diversifying your investments across different asset classes, sectors, and geographical locations can help manage risk. Even if one investment performs poorly, others may perform well, helping to offset the losses. Ignoring fees. Fees can eat into your investment returns over time. Be aware of the fees associated with your investments and your investment platform, including expense ratios for mutual funds or ETFs, transaction fees, and account fees. Even small differences in fees can have a big impact on your investment returns over the long term. Neglecting to regularly review and adjust your portfolio. Your investment needs and goals can change over time, and the market conditions can change as well. It's important to regularly review your portfolio and adjust your investments as needed. This could involve rebalancing your portfolio to maintain your target asset allocation or adjusting your investment strategy based on changes in your financial situation or goals. By avoiding these common mistakes, you can increase your chances of success and make your investment journey smoother. Remember, successful investing is not about getting rich quickly, but about consistently making smart decisions over the long term. 7. Conclusion. And that wraps up our beginner's guide to investing. Remember, the journey of 1,000 miles begins with a single step. Don't wait for the perfect time to start investing, because the best time is now. Reading widely. One of the best ways to improve as an investor is to read widely. This includes not only books on investing, but also financial news, company reports, and economic analysis. Some classic investment books that can provide valuable insights include The Intelligent Investor by Benjamin Graham and A Random Walk Down Wall Street by Burton Malkiel. Regularly reading reputable financial news sources can help you stay informed about market trends and understand the forces that drive the financial markets. Taking courses. There are many courses available online that can help you deepen your understanding of investing. Websites like Coursera, Udemy, and Khan Academy offer courses on a wide range of topics, including investing basics, financial markets, portfolio management, and more. Many of these courses are free or relatively inexpensive. Joining investment clubs or online communities. Joining an investment club or online community can provide opportunities to learn from other investors and share your own experiences. These groups can provide valuable feedback, help you gain different perspectives, and keep you motivated to continue learning. Some popular online investment communities include the investing subreddit on Reddit and various investing groups on Facebook. Learning from your mistakes. Making mistakes is a natural part of the learning process. When you make a mistake in investing, try to see it as a learning opportunity. Analyze what went wrong, understand why it happened, and think about what you could do differently next time. By learning from your mistakes, you can continually improve your investing skills. Using investment tools and resources. There are many tools and resources available that can help you make better investment decisions. This includes financial calculators, portfolio tracking apps, stock screening tools, and more. These tools can help you analyze potential investments, track your portfolio's performance, and make informed decisions. Consulting with a financial advisor. If you're unsure about your investment decisions or need more personalized advice, consulting with a financial advisor can be a good option. A financial advisor can provide tailored investment advice based on your specific financial situation and goals. However, make sure to choose an advisor who is fiduciarily obligated to act in your best interest. By engaging in these activities, you can continually learn and improve your investing skills. Remember, investing is a lifelong journey, and there's always more to learn. If you found this video helpful, please give it a thumbs up, share it with your friends, and don't forget to hit that subscribe button for more finance tips and strategies. Until next time, here's to your financial success.